All right. Well, thank you again. We're here with the Real Estate Technology Roundtable podcast. And yeah, we have Kirk Hawkins and Khalid Yateem here with our special guest, Sam. Sam, I'm going to butcher your last name. Sam Batayneh?
Sam Batayneh.
Batayneh. And yeah, he's the SVP of mortgage lending over at Guaranteed Rate, been a top mortgage originator in, top 1% in the whole country. So glad to have you, Sam. Thanks so much.
Thank you guys so much for having me.
Yeah, and I think, right before we started the podcast, we were just talking about, rates. We're here in, interest rates have been increasing at the Fed's been, increasing them pretty steadily. I think we just got a 75-point basis move. And yeah, it'd just be interesting to, go over high level of like when the Fed rate moves, it seems like it's moving the whole market in interesting direction. So it'd be good to get your take on that.
Yeah. Well, a lot of what the Fed does is counterintuitive. So if everybody knows the Federal Reserve is going to raise rates, number one, it's no surprise. And number two, it's already built into the mortgage market. So the mortgage market trades every single day like the stock market does. And when the Federal Reserve earlier this year signaled they were going to raise about 250 basis points, well, that instantly got built into the mortgage market before the Federal Reserve even did their first 0.25% rate hike. We were already up 2%. So we were in the anticipation of already living in their future that they scouted out for us. Now, counterintuitively, what happened was the Federal Reserve did raise 75 basis points at their last meeting. And since then, rates have actually come down on the mortgage side, because you're going to see the 10-year Treasury note, which is what mortgage rates follow, which is indeed a flight to safety and quality as a bond. So traditionally, when people are buying stocks, they're selling bonds. And when they're selling stocks, they're buying bonds because they don't want to go into cash. So they need somewhere to park their money, and that's the bond market. And the thought was that when the Federal Reserve did 75 basis points, there was a light at the end of the tunnel for these rate hikes, because in my belief, they need to hike right now fast to be able to cut to get us out of any recession or re-stimulate the economy when needed. So rates are actually counterintuitive to what everybody thinks. When they hiked the 75 last time, folks saw a light at the end of the tunnel, and mortgage rates have come down from then, because you've seen the 10-year Treasury yield, which topped out around 350. I want to say 3 Tuesdays ago. 2 days ago, we hit a low of 280, 2.8% on that yield. And today we're back up to about 3. So the hard edge definitely came off of mortgage interest rates since the Federal Reserve raised, because some folks in the marketplace took that as a signal as, oh, they're going to be done raising because they're going so much. So it's actually very counterintuitive. If everybody knows something, it's not news to anybody. And that's the same thing with the bond market this year. So when the Federal Reserve raises the next time in a week or two when they meet, they're, depending on their guidance and how much they go, my belief is if they go another 75 basis points, that'll signal the end of the road for the rate hikes, or very close to it. You'll see the bond market and the stock market rally further. And then beyond that, we've got a jobs report for the month of June coming tomorrow, and other economic data, which has been weak, which that has also gotten the idea of the Fed given the idea of the Fed getting off of their rate hike cycle that they're so insistent on, because the economic data is coming in weak regardless of inflation right now. And in my view, inflation is getting better on commodities, wheat and grain and lumber and all that stuff. But the most important inflation that we see every day is gas and food. And we've seen that come down a little bit. So the Federal Reserve, who can't help gas and food, knows that that's squeezing the consumer. So they might chill out a little bit. And that's why you've seen the stock market rally. And that's why you've seen the bond market rally since their 75 basis point hike.
Tim, what do you see as a bigger threat right now, or a bigger impact to mortgage rates, like inflation or an impending recession? Like, which, if in a tug of war between the two, which one is going to remain to be prioritized?
Well, I think they're one and the same. If the inflation doesn't chill out, which it seems like it is chilling out, knock wood, we will be then in a recession. But here's the thing about a recession, the R word, as I like to call it recently. A recession isn't the worst thing in the world. Everybody freaks out, recession, recession, recession. Recession is not the worst thing in the world because technically speaking, a recession is 2 consecutive quarters of slower growth. But we are coming off of 6 quarters of unprecedented growth because of all the money that was pumped in the economy. So let me just give you an example. Let's say we had 10% growth for 4 quarters in a row. And let's say we have 9% growth for 2 quarters in a row. Well, technically speaking, that is a recession, but you've still got 9% economic growth. So it's a healthy recession. So the whole idea with this recession is how deep is the recession and how long is the recession? So if the Federal Reserve thinks that that inflation, the one they can control, which is prime lending rate, which is what they raised, which sets the general environment, as we discussed, the mortgages got a year ahead of the Fed earlier this year. If the Fed thinks that inflation that they can't control, which is food and oil, is under control, and then they see the natural progression of lumber and commodities, which have come down a lot, the Federal Reserve will then not necessarily have to be as aggressive as they planned. Past this meeting, I think they have to go 75. And if they do anything different, markets will not like it because then they won't have a lot of faith in the Fed. So inflation itself, we've already seen the inflation in interest rates on mortgages. That's factored in, and we're probably not coming off the top here, like things have chilled out. But that inflation that a lot of people said isn't transitory, I think is transitory because everything else is chilled out. And you take food and gas out, and the consumer is tired from spending all their money on food and gas. So I think the answer to your question is one and the same. It's going to be about the Fed. I mean, here's the other thing. People need to realize our economy is completely supported by the Federal Reserve. Every time you see the Federal Reserve printing money and putting it out in the system, there's a lot of liquidity out there. And that money either goes to the consumer directly, as we found out during the last few years, or it's given to companies to buy their stock back, and people buy stocks with it because they have nowhere else to put it. So the Federal Reserve, when they're on board, the stock market does good and the economy does good. When the Federal Reserve's not on board, which is the case right now, the economy has to stand on its own 2 feet and figure itself out, which it has not done in a long time. Because right when 2008 and 9 happened, we had this new idea of too big to fail and systematic failures. A systematic type company failure could disrupt the whole economy, which it did. So right now, the Federal Reserve itself is the dictator of the economy based on their mood. And right now, the economy and the stock market's going to have to stand on its own too, without the support of the Fed, until the Fed comes back, which it will, because it always does, because everything is cyclical.
Do you think it's like, I have a theory that's not rooted in anything other than my brain, that is, there's almost like a movement towards boom and bust cycles. And like, I was in the real estate market in 2000, in 2008, and I feel like there's, and obviously you see this run up in the run up in the stock market, just in unprecedented ways. And to me, there a throttle. There were years of throttling opportunities, right? It's like the Fed, they have 2 targets, right? They have inflation and they have jobs. And I felt like they kept moving the needle, on that, and when there was an opportunity, in my opinion, to start raising rates as early as like 2011, but because it wouldn't have been favorable, they didn't do that. And in my opinion, there's just like, people who control decisions, or people, or the general population, they want to see massive growth in their, in their wealth, and their folks are willing to lean into that, even if it causes, a bust cycle, do you think it's going to be continue to be boom and bust, or are we going to finally like ever get to a point where it's just, steady growth?
Very good thought. We are a boom to bust economy, and I think this started heavily in the dot-com era, where speculation on growth became the driver for things. I believe before the dot-com era, so call it the mid-90s, the stock market and the economy had to stand on its own too, because there was no such thing as too big to fail. And if you failed, you failed. We just found out in 2008, a few of these big players too big to fail can't fail, or it's a systematic problem. The whole system will fail, which it did for a few weekends in a row back then. So yeah, we are indeed boom to bust, and every single cycle. And in terms of why that's the case, it's because there's an artificial I'm not going to use the word inflation. Artificial insemination of liquidity into the system by the Federal Reserve, which leads us to the big booms, which you can't run an engine that hot, growing that much or that fast for that long, or you overheat, which is the bust. And we go boom to bust, and that is our economy now, and that's because the Federal Reserve is involved, because they speed it up to a boom time, then it breaks. Then they speed it up to a boom time, then it breaks. So yeah, you're right. We are boom to bust. That's the exact way I feel. That's because of the Federal involving themselves, which they didn't do to this degree prior to the century, it looks like.
With all this in mind, in thinking of the consumer, the person in particular who wants to buy, I have a bunch of clients that are like, I'm going to wait and see, because I think the market's going to come down, and I don't think I'm ready to jump in until that happens. But what advice would you have for people with that kind of perspective?
Well, here's the thing. This is if it's their primary residence, right? If it's someone's primary residence, you need to think about that and treat it as a utility. So just like your phone bill, your water bill, your gas and electric bill, your housing is a utility. And if you're buying a primary residence and you've done the analysis of what your current expenditure is to have a shelter as a renter or your current home, and then you've done the analysis on a move forward, as long as those numbers are close, if you're buying something as your primary, it's always a good time. Because here's the weird thing about housing. Housing was not intended to be set up to be anything more than stability as the American dream of somebody owning a home and enjoying it and having that peace of mind. Just so happens housing ended up to be by default probably the greatest continuing investment, in the history of our country, I think by mistake or by default, because it was set up with such support when the government set up Fannie Mae back in the 1930s and Freddie Mac back in the late 60s to support things. And that liquidity they provided has kept the housing market healthy and going. So my advice to anybody is, if you're buying an investment property, you're looking at it as a business, and these rates may be too inflated for it to cash flow or to get done what you'd like to get done with it. But if it's your primary residence, you already have that expense, and you're never going to time the market right when it comes to price point or when it comes to interest rates. But here's some basic funny advice I can give. You can always refinance your mortgage if the market allows for it. You can never refinance your. So if it's a utility, meaning your primary residence, it's always a good time to buy, especially if your outlook is longer term, because don't take it as an investment. It was never intended to be that. It just ended up to be that because of all the support the housing market has from the government through Fannie Mae and Freddie Mac.
Yeah, and then if like you're saying, if it's your primary residence, it's, who cares if it's a little bit more or less? You're going to be there for a long time, so it will increase.
You're never going to time it right with rates on your purchase or with your purchase price on your purchase. But what you can time right after that is your refinance, if it becomes available, right? And if you're ready to live with the rate you have today forever on a 30-year fixed, if you like that more than you like your rent long-term, then you're good to go now. And rent, by the way, is only going to get more expensive because we have now in our country an overall general lack of housing supply. And that's not only single family residence, that's all, residential dwellings, apartment buildings, condos, whatever it may be, co-ops. We have a general lack of housing, and landlords know that. And I have a lot of clients who cannot wait to get some of their tenants out that are under rent control because they're going to go to the roof and to the moon on what they're going to charge the next tenant. So I think rents are going to keep going up. At least your mortgage, if you get a 30-year fix, or if you're planning right on an ARM loan, it's never going to change. And your worst case scenario is in play if you've got a 30-year fix. It can only get better. But if you've got rent, your rent can keep getting raised every year, which it will probably, because
Well,
there's just
that's an interesting point. It's just, I have this like theory, like called just this thought in my head where prices are, how much a house is worth is kind of inconsequential. It's the person that is like, they only have so much money they could put towards a house, and then they have $3,000 a month, and that gets them a certain mortgage value at a certain rate, right? So yeah, like the prices, can you talk about that? Like how, like people's income generally doesn't change that much, but prices seem to go up and down on these homes, but it's really, they have $3,500, $3,000 a month to spend, and then rates are moving up and down also.
Yeah. So what you're talking about is affordability, which is the whole key to the housing market, essentially. So give you an example. You're right. People's wages have not gone up as much and as fast as home prices have, but up until this year, interest rates made up for that. And that's the reason prices went up, is because the buyer pool for any price point was almost exponentially expanded when we had 30-year fixed rates under 3%, because affordability was there, regardless of price, right? Affordability was there. So now what we're dealing with a little bit is some prices from yesteryear, which we've all seen: price reduction, price improvement, newly priced, new price, however the agents want to do it. And that is a reflection of affordability, because now it call it 5% for a lack of better, compared to 3% before on a 30-year fix for a lack of better. Affordability isn't there. So let's say there was 10 prospective buyers for a property. Now there's only 4 of those people that can actually afford it out of the 10. So now there's only 4, right? So the demand has come down because of affordability. So wage inflation has not kept up with the price of homes, but the reason the price of homes went up so much and outran wage inflation so much, because interest rates came down so much, which took the wage inflation, made it here nor there, because people could qualify without their wages being inflated, because the affordability got so much better because of the rates. So it's all about affordability. And I'll tell you this. So typically, the debt to income ratio we run on mortgages to stay as a qualified mortgage QM is 43% or under debt to income ratio. That's off your gross number, call it on a W-2. There's some lenders, and Fannie Mae and Freddie Mac, which allow this thing called the patch, which they talk about getting rid of it, but it's still here. The patch being 43% plus debt to income ratio to 49%. Well, that in and of itself, the lower rates and that little patch helped a lot of people qualify even at 3% mortgages that couldn't. So put it like this. I'd say about half the new purchases we did last year, the people at today's rates could not afford them because the rates are higher and the property values have not adjusted yet to the new rate environment. They're slowly but surely doing that, but the property taxes are also higher. So affordability got taken out, which makes a buyer pool smaller for any given price point, which that in and of itself is going to bring down the prices. Now, are they going to crash? No, not at all. By no means at all. There's a general lack of inventory, and the mortgage market is as liquid as can be. Just the rates are a little bit higher. And the government learned in 2008, you can't let housing crash. In my opinion, the best thing they did during the pandemic recently, this was very low key. They gave the forbearance. They allowed the consumer to not have to make their payments. And in turn, at the same time, allowed the banks to not have to mark their assets of the non-performing nature of a mortgage that isn't paying because they gave the consumer a hiatus, they allowed the bank to not have to mark that asset to zero. If they would have done this simple thing, they didn't know they had this available, but they took a decade and came up with this. How do we avoid another housing crash? Well, they did it. They did it. The housing market should have fell apart in the beginning of COVID. Instead, with that one little move, allow the consumer a vacation, a hiatus from paying their mortgage, and don't make the banks treat that as a non-performing asset. Everything stayed healthy and liquid. The banks also stayed solvent because they went insolvent before when their mortgages weren't performing. This time the mortgages weren't performing, but they weren't required to mark in the market. So we're never going to have something that happened before, given the circumstance right now. Just won't happen. The government won't, and they know to protect it by all means. So the fact that housing thrived during the pandemic is insane, and it's because of that one reason and one reason only no one talks about. It's the forbearance the government did. That kept the bank solvent, and that kept the consumer more than solvent for that matter.
That's interesting. I didn't realize that they basically waived the mark-to-market effect on the mortgage side. I did not know that. That's That was very interesting. That's very interesting. That was a lot of the big. I remember back in 2008, like Tom Keene, he runs a podcast, Bloomberg on the economy. I mean, a lot of that was talking about mark-to-market and just the assets. Like, I mean, that's what really started. Like, Washington Mutual, I think, was one of the first banks. When they had it was a mark-to-market situation, and that really was what I think triggered ultimately a run on the bank until J.P. Morgan bought it.
Absolutely. Well, J.P. Morgan was forced to buy Washington Mutual, and Bank of America, Merrill Lynch were forced to get together, and this one was forced to get together with that one. I mean, they took something that was too big to fail and made it colossally too big to fail. I mean, these banks are so big now, it's insane. And before they were big, but now they're way bigger than they were then. I mean, way. So the government knew if they didn't make them insolvent, make them mark to market, they knew if they gave the consumer time off of their mortgage, things wouldn't fall apart. And then they started buying treasuries and mortgage treasuries and mortgage-backed securities. And when you hear about the Federal Reserve's balance sheet, that's what's on it. Treasuries and mortgage-backed securities. And when you hear them now saying we are unwinding our balance sheet, well, they're selling treasuries and mortgage-backed securities. And that's why the yields went way up. It's because they have to incentivize another group of people, not named the Federal Reserve, to buy them, which they found a lot of takers at 350 a couple of weeks ago, ran it down to 280. 70 basis point move's a big move. Just in a couple of weeks, just like we had a 70 basis point move up in 3 days, 2 weeks before that. So the market's finding its footing, and it looks like this 3% level right now is going to be a give or take 20 basis points until something happens. That something could happen tomorrow when we get a jobs report. If it's weaker than expected, you'll see the stock market rally, you'll see the bond market rally, because the thought is, the Federal Reserve is going to back off now because we're not even creating jobs and blah, blah, blah. And we see these inflation numbers coming down and these core numbers and all that. So it's really the whole game is about the Federal Reserve with the stock market and with housing. So when the Federal Reserve is participating, meaning buying treasuries, putting liquidity out there, buying mortgage-backed securities, rising tide lifts all boats. Now we're going to see our market, our economy and the stock market, at least for a little while, based on what the Fed's saying, get back to, okay, let's see how you do on your own without us now. Because we've been with them now since 2008. We have been completely dependent. If you go look at every time the Federal Reserve has backed off, markets always sell off. Rates always go up because they're not buying the treasuries and mortgage-backed securities. And the liquidity to put in the stock market for companies to buy their own stock back isn't there. So any dip you've seen since the Great Recession has always been when the Federal Reserve is not participating, and every huge move up you see is because the Federal Reserve is participating. So I'd like it to get back to a normal place because, the belief is the Federal Reserve, can just keep printing money, and right now they can, and right now they'll find someone to buy it at whatever yield. But we have to have the overall global belief that the Federal Reserve is the end all be all. The chairman of the Federal Reserve is basically the most powerful person in the world. There's nobody more powerful. He can come out right now and say two things I don't even know, good or bad, stock market go up or down 2,000 points in 1 second if he says 2 words. And that's a very powerful thing right there.
That is. So your kind of predictions, if I'm hearing you right, is you think they'll raise again, or they should raise again. Is that correct?
Well, I actually thought that before they raised and when they did their 25 basis point raise, the first toe in the water, they told us they were going to go 250 basis points or so, and they only went 25 during that first raise meeting that they raised. I thought they should have got it all over with there. They should have went all 250 there, ripped the Band-Aid off, because if they were so worried about inflation, why worry about today's inflation? Why try to take care of, inflation in 6 months? So, then they went 50, I'm sorry, they went 25, then they went 50. Then they finally went 75 because the Friday before their meeting, this out of control inflation report came out, and either they knew it was coming and it scared them. That's why on that Tuesday night before they raised rates, they put something out to one of the newspapers saying we're probably going to go 75, and they did. I thought they should have done all of this months ago, because then the Band-Aid's ripped off and we can see what's what, right? Inflation should be taken care of if you go up 2.5% overnight. Now it's been like this dripping, like torture thing where is it going to be 25? Is it going to be 50? Is it going to be 75? Now, if they go 75, markets will like it. Things will stay steady. There shouldn't be any great shocks up or down. If they go 25 or 50, it's going to say, wait, where's our the markets will say, wait, can we believe the Federal Reserve? Can we trust the Federal Reserve? Do we think the Federal Reserve knows what they're doing? Because one day they're so sure about it, the next day they're not. All people are looking for essentially is confidence, because that's what the economy is based on. That's what a lot of things in the world are based on, financials, confidence and sentiment, right? That's how we have the consumer sentiment number that comes out once a month, University of Michigan Consumer Sentiment Index number. And that gauges where the consumer is. And if the Federal Reserve, they're going to go, I hope they go 75. I hope they go 100. I don't care. If they go 150, that's fine with me. We've already got it built in and we're already coming down off of it. Right.
Oh, got you.
Yeah, we're already there. We already said they were going 250.
So now, if they go up 75, rate should hold at that 3% average-ish.
On the 10-year Treasury, I wouldn't see any crazy movement because we are already expecting it. Right. So, I mean, like I'll get calls every time the Fed raises rates from my clients saying, oh, the Federal Reserve raised rates, so now it's 3/4 higher. My answer usually is, well, recently was no, rates went down. And everyone's like, wait, why? It's not about what the Federal Reserve does or says today. It's about what we think the Federal Reserve is going to do or say, because we already know what they're doing. And again, if everybody knows something, it's not a secret, and everyone would be a gabillionaire because the Federal Reserve is going to do this, and this is how markets should react. No, the market since the Federal Reserve, the economy since the Federal Reserve got themselves involved in 2008 is not based on a freestanding economy. It's based on an economy that has the Federal Reserve backing it up every step of the way. And in one major way, it's socialism is actually what it is. We have a capitalistic economy every day of the week until we need to be socialists. And then we're socialists for a few months, giving everybody money, and then we're capitalists again, right? And that's kind of that boom or bust. During the boom time, we're capitalists. During the bust time, to get ourselves out of the bust, we turn into socialists. And then we go back to the beginning again. And that's what we're doing now. The market hasn't actually sold off as much as it should have, given the doom and gloom everyone's talking about. And that's a good signal for you. Markets are in bear market territory, and some of the issues inside have gotten beat up, but the overall top line numbers aren't as bad. And by the way, in 2014, the stock market, the Dow was at 14,000, I want to say, and the 10-year Treasury yield was at 3. In 2021, the stock market was at 36,000 and the 10-year Treasury yield was 70 basis points. 2022, the stock market's still at 30,000 and the 10-year Treasury yield is at 3. According to historical numbers, the 10-year Treasury should be yielding 6+% right now, but it can't. It literally cannot. The economy would fall apart. The world economy would fall apart. The money that countries and banks lend each other is not geared for that higher interest rate environment. So if we haven't gone up to a 6% yield and the stock market went to 36,000 on the Dow, when we had a 3% yield and the stock market was a 14,000, take that as a signal that the bond market, the 10-year Treasury, cannot go up any higher because there's no reason for it to, because people should have been, because for the last 2 years, stocks were rallying and bonds were rallying. That's not a normal relationship. The Federal Reserve kept printing, buying, and it drove both values of those things up, which is not the traditional way. So now if we get back to normal, if you see the stock market sell off 5,000 points in the next month, you'll see the 10-year treasury yield go to 220 probably, come down another 80 basis points. So that's the whole economy is counterintuitive to what people think. And if it wasn't, everyone would be rich. That's the proof that it's counterintuitive.
What do you think? What do you think in terms of in terms of rates on going back to kind of housing rates and everything like that, this lock-in effect, right? So there's one of the things that I see as being a floor of stability in the housing market is two things. One is you have, for the recent time in history, you have corporate purchasers, right? And maybe not as much in California, but you've got Invitation Homes that's buying, thousands and thousands of, properties, large swaths of neighborhoods, right? They have big balance sheets so they can weather the storm of any decline. So it's, gobbling up supply, right? And then you've got everyday retail buyers that are, that got these rates, and they're not, in my opinion, a lot of them weren't adjustable rates. They got these bare bones fixed rates during COVID, for nothing for 30 years. Why would you move in 30 years? You don't have it. So to me, it's interesting. How do you ever solve? This is a multi-part question, so take whichever piece you want. But how do you solve affordability when you don't have supply? Supply can only be changed if you start building, because I don't think anybody's going to get out of the house that they basically pay zero for, or banks that or large institutional investors that have it. How do you navigate that environment? I don't feel like that has ever happened in the previous century.
Well, on a case-by-case basis, affordability is to each client separately, because it's not just a huge pool of people. Put it like this. So let me just use a number, for example. Last year, if I had a client that came to me with a W-2 of $450,000 a year, I could probably on the back of a napkin do a pre-approval for them, because if I just asked them, do you have any debt? No. Do you have this? No. Do you have that? No. Okay, blah, blah, blah. I could probably do a pre-approval on the back of a napkin, because at those rates, if they weren't way overshooting and they had the down payment, they could afford it, right? Now, somehow at 5%, for example, we're stretching out on somebody who makes, 400 and some odd thousand a year on a W-2, which is the easiest underwrite for us. So it's not about affordability right now. Well, there's one thing you mentioned. People are not going to sell their 2.75 30-year fixed loan. And I have a phrase for it. I call it mortgage love, because even if they don't like their house that much, they love their mortgage, so they're going to like their house a lot more. Two things. Number one, the mortgage is, a lot less than it is today. But number two, their property tax basis is also a lot less today. So the affordability that's in place, it's going to be hard to get people off of, to sell. It's going to have to be a life event to get rid of that mortgage. But there is no selling affordability. The person that wants that house has to afford that house in the moment, which then sends us back to basically a needs-based market. People aren't just going to want to buy the house down the street because it's nice and they've seen it every night when they're walking their dog for 4 years. They're going to say, yeah, that's nice, but the mortgage on that is not nice, so I don't love it anymore. If, for the last few years, with the exception of a couple of hiccups, but we were able to a year or two later refinance anybody who got in at an elevated rate. I think we should be able to do that now, but I don't know. I mean, rates could take a turn to 7%, on a 30-year fixed, which I don't think the housing market can handle it. I don't think the economy can handle it. I don't think anything, but it could happen. And we would then see rich people not be able to afford the house they want until that house price came down to adjust to it. And here's another thing with affordability. So like that I talked about last year, affordability was made possible even though the prices were going up and wages were not rising to that degree, but rates were coming down much faster than either one of those things. So the affordability level you know, at 2.53% 30-year fixed is worlds different than it is at 4.5% or 5%, right? So there is the affordability in a needs-based market. Otherwise, there are no luxury moves, meaning my example of you're walking your dog and you love that house, because you've always been able to swap out your mortgage to some degree. Whether there was a 6 or 12-month lag, I always have been able to get somebody a lower interest rate than they had previously, all things being equal. We don't know if we're in that environment now. So right now, this is a very needs-based real estate market, not so much, oh, love that house, money's cheap, let's go. Money's expensive, and the mortgage they have now, odds are, is better than any mortgage they're going to get today. So inventory values are also going to be supported because of people not wanting to get rid of their mortgage at 2.75 because they couldn't afford that same house today. I know that for a fact.
So the only real way then, in theory, is that you generate more supply is if unemployment spikes and people literally can't pay their mortgage and there's no mortgage relief and then there's no cash flow to do that, and then they have to trigger a liquidity event.
That on a wide scale, that would hurt the housing market. If we had mass 10 million people a month losing their job, yeah, the housing market would collapse. Just like the economy, with the whole, I mean, it wouldn't be housing you'd worry about at that point, it would be the whole economy. And housing would just be one of those things that got thrown out, you know, that just got hurt like everything else. But housing itself is very protected by the government right now. Yeah. It's very protected by the government. They will not let it fail because they know that is a systematic failure, because housing is about 30% of the economy when you add in people that do what I do, what you do, title, escrow, appraisers, notaries, inspectors. I mean, there's a million things related to real estate we don't even think about, right, on a daily basis. So if we had mass layoffs, you wouldn't be worried about the housing market. You'd be worried about everything else, and the housing market would be a part of it. But the housing market itself at this moment will not be the triggering event that sets the economy down, because it really sincerely already would have been during COVID. I mean, not only did we get through that, the housing market flourished through that. All-time everything, all-time low mortgage rates, all-time high prices. And no one was leaving their house. Now everybody's out and about, and look, counterintuitive, right? Why would the stock market go up during COVID, but then go down now? You know what I mean? Everything's counterintuitive. That's what I've learned about the economy and economics. Whatever you think is not the case. And I've learned that by listening to my clients, because these are very smart people calling me, telling me rates went up. Meanwhile, rates went down, you know, but they heard rates went up. So that's what everyone thinks.
Totally.
I feel like I went to Sam's Lending University. Right? I love it.
Totally. Professor Sam.
That's very kind of you guys. Thank you.
Thank you. Yeah, no, it's hopefully we could do this more often, and you know, just kind of pick your brain on what's happening in the market and with rates. And then how to translate this to, you know, Kirk's talking with a lot of buyers, talking with sellers, you know, people are moving around actively. So how to
and in California, we're very lucky. People are very active here, you know. People are very active. They like to invest. They like to move. They like to do things more so than in other places. I mean, the average loan prior to this era, when I mean this era, I mean prior to 2008 and 9. I actually don't know the stats since then, oddly enough. But the average loan was always held for about 7 years. It might have had a 30-year life. Now the average, at that point, the average loan was held about 7 years. Now that number is going to go way up when we look back in 10 years from now, because all these folks, I have some clients in the 15-year fix in the high ones, clients in the 30-year fixed, you know, mid to high twos. They're never getting rid of it. They're not.
Right.
I hope I can finance them one day, but I doubt it. But you never know. You know, you never know.
Right.
Yeah. But no, the market right now does seem healthy enough given the shock that went on. Because I'll tell you this. Let's just say rates went up 2% from January 1st to today. If we would have had that 2% raise happen over the course of 2 years, at 0.25% every 3 months, all of this would have been digested and taken into place, taken into account for, and adjusted for properly, because it had time to digest. You know, you could chew what you bit off. Well, they just shoved 2% higher rates down our throat in 6 months. And given that that happened, we wouldn't have noticed any of this. We would have just looked back in the previous scenario of 0.25% every 3 months and said, wow, rates are up. And not really any big talk about it, just you look back and, oh, rates went up. But when it happens over the course of 6 months, and really the heart of it happened over the course of 10 weeks, it is a shock to the system, where there was a few weeks there, I was writing a pre-approval for somebody on a Monday. By Friday, they didn't qualify. And that's a really rough thing, because they were out and about that weekend looking for a place that 5 days ago they qualified for. 1 day ago, they stopped qualifying for. So when I saw that happening, I knew they were looking at it, to pick up the phone and call them and say, hey, I need to adjust your pre-approval. They say, why? I said, well, rates went up, 0.5% this week, which is, an extreme thing. And we're probably past that. So the market right now, honestly, considering the big jolt and shock we just went through, hopefully we're done with the jolty, shocky things right now. It's very healthy, because it really, 2%'s a lot. 2%'s a lot. I mean, coming from 3, call it, to 5, call it, virtually overnight is tough to digest. I think the housing market's done a very decent job of digesting it. And I think that all comes back to lack of inventory. Because if there wasn't a lack of inventory, and there was let's just say there was a glut of inventory on the other side, you would see housing prices come down because of these rates. Because that's traditionally what would happen if affordability comes out of play. Right now, they're going to come down, but they were too inflated. 10 or 20% off the top is because you had a 2.5%, 3% 30-year fix. Well, it's not that anymore, so you might lose 10 or 20%, but that was fluff anyway. And back to it, if it's your primary residence, you've got your rent isn't free. You know what I mean? Your rent is not free if it's your prime. You're paying something. So don't be scared. But I think the housing market is actually very healthy, and based on what things look like in the second half, we could see things creep down to the low 4s, knock wood, high 3s on a 30 fixed, which would put the housing market in a tremendous place, because the liquidity is still there. And you'll see banks get very aggressive. And I'll say this also, there's probably 0.5% of fluff and fear right now built into these interest rates. Because what I mentioned, I was writing pre-approval for somebody on a Monday, and by Friday, because rates went up 0.5% that week, they didn't qualify. Well, when banks and Fannie Mae and Freddie Mac and secondary markets are giving their pricing out right now, they built in probably 0.5% of fear because of what we just saw happen a few times this year. So they didn't want to have a rate lock go out at, call it 4.75%, and 5 days later have it be at 5.25%. So they're just putting the money out there, for example, at 5.25%, where they could be putting it out there at 4.75, but they're not, because they don't know what tomorrow holds. So if you just see everything stay equal and settle down, just to say we have a 3% yield in 2 months from now, rates will naturally be 0.5% lower, because the fear is gone. And there's a lot of fear and fluff and hedging built into these interest rates right now. And that's starting to come off a little bit too.
Awesome. Well, thank you so much, Sam.
Yeah.
How can people get a hold of you?
Well, you can find me on Instagram or Facebook or LinkedIn or any social media out there, Sam Batayneh. Or you can visit www.rate.com, rete.com/Sam B. Or you can call Kirk and get my number.
Get Kirk to get Sam.
Yeah, it's guaranteedrate.com, and you can look up Sam Batayneh. But yeah. Thank you again. There's so much info that I can now go back to my clients with, and help them, make informed decisions too.
Yeah. I mean, that's my number one job here. My role is an advisor, and if there's a deal to be had, we'll look at it. But a lot of times my advice is sometimes no deal is the best deal. You're good where you are. Right. And if I have to give that advice, it's the same. I'll give the advice of, you're not good where you are. We should do this. So, real mortgage brokers and advisor, I lost a deal yesterday. A client was dealing with private banking. They were giving him 1% off the rate. I told him to take it and run. Nothing I could do for him. That, they were doing better for my client, 15-year client. I had to tell him to take that and run. He said, are you sure? I said, well, are you sure you want to pay $700 more for my rate? Because they're going to lend you back your money. He's got to move in $1 million over there. So got to give the advice when it's sound. I had to tell my client to go with somebody else. So a real mortgage broker is an advisor is what we are. And you have to understand, a little bit of economics, but more so than anything, you have to understand your client's scenario. Because if a client comes to me and their rent is somehow $1,800 and they're stretching out to get a $7,000 housing payment, and they don't love what they're buying and they don't hate what they're leaving, sometimes staying still is the best move. Who knows, right? Everyone's different. So we just
Right.
talk on an individual basis.
All right. Well, thank you so much. And yeah, all the links for Sam will be in the show notes, and I appreciate it.
Thank you, guys.
Have a great day.
Thanks so much.
All righty.